The large banks of America have already shown their earnings results, so this can actually be signs to see how SoFi might compare whenever we see how their earnings actually went. So in this video, that's exactly what I'm going to do. Let's jump into it. Now first, I just want to say that Q3 and Q4 seem to be very similar in a lot of ways. Personal loan portfolios are growing like crazy, deposits are down, but yet net interest margins and net interest incomes are spiking like crazy. Now what this means is simple. Because interest rates are going high, that banks have to also increase their personal loan values, and so they're actually ending up getting more income for holding these loans than they were previously. And funny enough, because the interest rates are rising and they're raising their personal loan values, they're not raising their deposit rates nearly as fast, and so their margins are actually standing out to be quite strong. Remember that banks fund loans through your deposits that you actually give to them through the bank. So the deposits, although being a great thing because they can fund their loans, is actually a liability to them. The large banks would prefer to have these deposits as low as possible, so then they can actually keep the highest amount of margins for whenever they're actually giving out their loans. So I don't actually think our deposits will be down at all. However, I do think that personal loans will still be a very strong category. Let's also not forget that this is the second most important category to me and where I see a lot of our growth. But in terms of these lending portfolios across the board, they all saw home loans actually be very much decreased, because whenever the real estate market suffers, so does the actual lending departments that have to deal with the slowing in the actual demand. But the loan portfolios in general are in question right now because the provisions for credit losses are spiking like crazy. What this means is that banks are expecting higher losses from their lending departments, and so they're actually having to write off a lot of their future earnings because they don't actually think that they're going to earn it. They think that delinquencies are going to increase, which is going to lead to them having to write off a lot of this loan portfolio, so they're not actually hitting a lot of the earnings that they really want to going forward. There was a thread written by Genevieve on Twitter where she actually talked about how important it is because it's a future-looking metric, instead of all these past metrics that we see on earnings results. I will also add that Ally Bank, also showing an increase in provision credit losses, did not show anything near what the big banks were showing. So, is this an Ally-specific trend, or is this a neobank specific trend where digital banks are actually improving on these metrics? Or are they just completely wrong and that their provisions are actually completely off and they might actually get hit with an amount of losses that they just simply weren't expecting? Now remember that all these big banks are laying people off in their businesses, and Noto even came out on Twitter saying that he's hiring. So we're going the complete opposite direction as the rest of the banks. So just like Ally, is this a trend going for neobanks where we're actually growing where the others are losing? Or is it just a little bit of ignorance and we could actually get caught up in a losing market? But back to the prediction, capital ratios or CET1 ratios for these banks have also increased very healthily, because obviously they're expecting more losses, so they want to have those capital ratios in order to actually fill those loans back if delinquencies are to rise. Because the stock markets are starting to show a little bit of optimism, they're actually seeing a much higher performance in the amount of net inflows that people are putting back into their investment accounts, as well as the actual appreciation of those assets because of the people who are holding. This could be a great sign for SoFi, as SoFi Invest has already been a platform that we absolutely love, and our financial division is the #1 metric that I'm looking for in this quarter. Because of the speed and growth in our financial services department, this could actually increase this if people are putting more assets and net inflows, and that people actually want a new way to get back into the stock market. It also helps with the diversification of our revenues and makes sure that we're not going to bankrupt ourselves by only being a lending department. We just got out of the idea that people thought that we were a student loan lender. We don't want them to just start thinking that we're only a personal lender. We really are a one-stop shop for all things finances. And speaking of financial services, across the board in all banks, we're seeing an increase in credit card portfolios in their lending departments, as well as actual spending with their credit cards. This also falls under SoFi's financial services division, and I really hope that it outperforms because I've always been a really big fan of credit card companies. The companies are really easy to maintain, and they're a win-win situation for both the users and the company. It's an amazing product. But those are by far the biggest metrics that stood out across the board whenever it comes to metrics that also apply to SoFi as well. Now, I've been saying that I'm not sure if SoFi will do a triple beat this quarter because obviously they took away our student loans, which were supposed to return for January 1st of 2023. Now, although that's not actually in Q4, a lot of people were supposed to be signing up before that actually happened in anticipation of that relief. However, whenever we look at the past performances of SoFi of whether they did a beat or not, it's been absolutely clear that SoFi likes to underestimate how much they're going to earn and then overperform whenever the earnings actually come out. So we're expecting a good quarter regardless of this actual student loan outcome. In Q4, SoFi is guiding for $423 million worth of revenue. In Q3, however, last quarter, they actually guided for $370 million, but it actually came up to $419 million. 13% more revenue than what they were expecting. But EBITDA is really where it's exciting. They're expecting around $45 million of EBITDA as a guide for Q4. However, in Q3, what they actually got was $44 million of EBITDA when really they were actually only guiding for 33, which was a 33% increase on what they were expecting. So will that be a similar trend for SoFi in Q4? Really what happened in Q3? Now, what I will say is that everything that we've seen so far from Q3 to Q4, everything is the same. Personal loan growth has been amazing. Deposits have been down for big banks. It looks like a very similar quarter, except with larger numbers, right? I actually think this is going to be very similar for SoFi. Even whenever we look at obscure metrics like website traffic, you can also see that SoFi is still on an uptrend. And, part of this quarter, October, was some of the highest numbers that we've ever seen in this company. That is still this quarter. So whether that was for student loans or not, that still is an impact on us and could lead to higher revenues, even if some people actually chose to refinance back in October and November before Joe Biden had actually extended it. That would still be a customer of ours. So here are my predictions for Q4. SoFi Invest will see large growth, just like the rest of the markets where they're seeing net inflows for people to actually buy new stocks in the stock market as optimism is starting to return. SoFi Money will see lots of growth due to its APYs on our savings accounts of over 3.75%. Even for the highest of net worth clients, that is a risk-free, cost-free way to actually get a really good rate on your money, unlike some of the other competitors that might be charging for a premium service. And to get that 3.75%, you need to be a direct deposit user, which will lead to other cross-selling of other products. In Q2, we saw a 37% chance of someone who gets a SoFi Money account to get on direct deposit within the first 30 days. In Q3, we saw that jump up to 50%. Now, in Q4, expect that to go even higher as our interest rates are extremely competitive. For personal loans, expect massive growth. Potentially even the highest amount of new personal loans that we've ever seen. The industry is showing that they really want this product, and we offer some of the best solutions out there. And like I said before, with interest rates rising, we are also increasing our net interest margins, which will inevitably see the largest net interest income that we've ever seen from this company. For this quarter at least, this is still the bread and butter of our company. Home loans, don't expect any excitement here, as there really is still a slowing market and no quite interest for this product, as well as also adding in the fact that we have a broken partnership that is not actually getting us what we need out of our home loans. Net interest income is still expected to grow, which could increase our actual weighted average in terms of our whole loan portfolio being more dependent on home loans, but don't expect many users to actually come to be new users for home loans. For student loans, I expect that we'll see a marginal increase on the amount of people that actually sign up for student loans before the moratorium was actually, pause extended. Is this going to be anything meaningful in the quarter? Probably not, but it is still good to know that we'll probably still see some growth here. Credit cards. If we believe in what any of these other banks are telling us, that volumes will be up, the amount of loan portfolio will be up, and the total growth in our credit cards will also be up. Expect good things. However, in Q3, I also expected better numbers than what we actually would have seen, and that didn't actually come to fruition, so we'll just have to see. For our technology platform, I find it really exciting that, like credit cards, all the transaction volumes are up. That makes it really exciting for Galileo. However, the amount of new signed partnerships I think might be very abysmal because small fintechs are not coming into this marketplace nearly as much now that VC money is absolutely wiped out. And unless we start to close some of those larger accounts like what they've been talking about, we're not going to see a large growth in the actual amount of accounts that come in this time. And then there's SoFi at Work. There really isn't a market right now for anyone looking to increase their group benefits right now, and so expect SoFi at Work to not see really any growth. But tell me how these predictions actually line up against the top 5 fintechs for 2023. Aside from that, guys, thanks for watching. Bye for now.